Hello ladies and gentlemen, welcome to our final webinar for this month. I'm Joseph Novichkov, Senior Trading Manager with GDM, and we'll gladly talk about oil prices today with you, as well as it's our last topic for this month. Very soon, from the beginning of next week, you will be able to find our new webinars for next month. Still, I'm yet developing the next topics, so it could take a few more days to set them up. So obviously from a Monday, Tuesday, it will be applicable on the website and you will be able to sign up for the next series. Firstly, however, at the end of the month, today, also the end of the week, and most importantly, we will talk crude oil. When we speak about crude oil, ladies and gentlemen, the first thing that has to come to mind is that there are two main benchmarks. Now, this is the North American benchmark, or the oil that normally comes from the Gulf of Mexico. This is the light crude, or the West Texas Intermediate crude oil, and the Brent crude oil, which is the world benchmark. So the world benchmark, the Brent crude, is the heavier oil. It's normally drilled from the North Sea. However, speaking of Brent crude and light crude, which is the West Texas Intermediate, or the WTI, we need to find the connection between those two benchmarks. So we will be talking a little bit more about the spread between those two benchmarks, how exactly it's moving, what is the moving force in general for oil, because fluctuations between the two benchmarks, like for example, one of it is selling for, let's say, $60 a barrel, which is the Brent crude. The other one is selling for $50 a barrel. The difference between the two prices is the spread, the so-called. However, the Brent crude oil that is used as a major price benchmark for oil worldwide isn't really the moving force for the West Texas Intermediate. On another hand, the factors that are influencing the Brent crude, for example, are also influencing the West Texas Intermediate, the light crude. Now, due to the huge stature in the crude oil market, Brent crude oil prices are influenced by a host of factors. Now, these factors, ladies and gentlemen, influence the price of just about any crude oil brand, or let's say brand or blend, whatever that you want to call it. So whatever is influencing the global benchmark is influencing every different oil that comes from the ground, whether it's sweet or not that sweet, whether it's shale oil from US, so on and so forth. The geopolitical and economic factors, with the case in point, which is, let's say, the Iraqi wars in the past and unrest in general in the Middle East, is the major factor that actually influences oil prices everywhere. Now, this is very easy to come to mind, the explanation why. This is because whatever unrest, civil unrest, whatever geopolitical turmoil that is happening around the world can actually influence the supply of the oil. From then on, it will actually change the equilibrium between supply and demand. So the less supply, the more demand. Obviously, prices are going up. But this is probably known by the variety of traders. You know, the supply and demand equilibrium curve. Also, the spot prices are also different from what you can get as a futures price, you know, just a few dollars difference. As well as we spoke the last time about gold, you know, the price of gold, for example, on bullion, you know, for the metal itself is a bit different with a few dollars than the spot price that we're trading. Well, basically this comes because of the different markets that we're trading. So in general, this doesn't concern us that much. The only thing that we need is to know the direction. To find that direction, ladies and gentlemen, as well as we did the last time with gold, we need to backtrack a little bit of history about oil in general. What it means, what are the past factors that are influencing oil to make the connection with today's market to see whether those fundamentals are still on play. However, every year is different. Major economies influence the market differently. So for 2015, for example, there are 5 major factors that influence the oil market. However, before we get to that point, we need to start from a little bit backwards. For example, in June 2014, traders all around the world were hindered by Iraq from exporting oil, which would of course potentially affect worldwide oil supplies, thereby potentially making oil demand higher than supply. This fear resulted in market activities that drove oil prices high in a short period of time. As well as we saw only weekly report from the Energy Information Administration, which of course we already spoke about these particular reports, and we're not going to get that far deep into these, because the last time we made our fundamental analysis to connect it with our trading plan, we saw which are the pieces of the puzzle that we can use on daily or weekly basis to trade every different instrument. But trading oil, like for a long-term period, we need to know which factors can stand on our way if for any chance we are on the wrong side of the market. So the Iraqi crisis did not alter oil exports from Iraq in reality, just the price itself. So for the most part, oil price movement here is a result of the market psychology. This is something that we spoke about many times when we've been talking about commodities or any type of trading, whether it's futures or spot prices. So the takeaway from here is that any geopolitical event that poses threat to oil supplies from a major supplier would mostly certainly drive oil prices high in a very short period of time. Basically, if we get an announcement, let's say, that some particular oil rig in the Middle East has been shot by rebels, okay, for example, we can see oil climbing with $3, $4, $5 even for one day, which is a major movement in oil price. For example, we have seen, and we're very much used to see gold fluctuating with tens of dollars, let's say $10, $20, $30 on some major announcements, and this particular move is not much of a big deal. But when we're used to see oil, for example, fluctuate with not more than $1.50 on a daily basis, $5 difference in price could be very, very huge for any trader. First of all, because the danger that it poses to our accounts if we are on the wrong side of the market. Therefore, we need to be informed all of the time on what is happening on the region around those major oil producers. For instance, any analytical thinking person can come up with a prediction of, let's say, some kind of an expectation that oil prices will dip if, for example, economic strengths are also weak. Now these two, they go in a correlation. So if we see some economic downturn, okay, this will also affect the US dollar as the major denominated currency for oil, but it will not play such a significant role to support the oil prices rather than very bad numbers for an economic development or some kind of a slowdown, which of course, like factory orders, any kind of machinery output, because those sectors consume much more energy in a larger scale than a normal consumer. For example, if any of you, ladies and gentlemen, have a motor vehicle, you know, you go to the gas station, you need petrol. So you also play a very huge role on the movement of these prices, but every individual by himself cannot move the market. It has to be with the herd. That's why an economic downturn can also result in a weak oil prices, because there will be less demand on the market and there will be more supply. Therefore, the equilibrium is changing in favor of the supply and, of course, driving the prices down. Just like the West Texas Intermediate crude oil, for example, OPEC supplies also influence both benchmarks, the Brent crude and the light crude. A reduction in OPEC production, for example, target is likely to drive Brent crude prices higher, much faster, but in result also the West Texas Intermediate as well. Sorry, I'm just going to pause here for a second. I had a gold position from 1149. I'll just close it on the first target. That was a very beautiful profit here of $4,000. Now, traders of Brent crude or West Texas Intermediate as well, they can profit from both benchmarks because it mostly move in one direction. One of it is slower, the other one is faster, but still the direction is one and the same. But slowly but surely, the spread between the benchmarks are either shrinking or expanding. So later on we will talk about the spread, so you can have a little bit of clarity on what I'm trying to get here. But first, let's talk about the Libyan crude oil production, for example. Levels are also influencing the oil market right now. When supplies were firstly cut from Libya, when there was civil unrest, as you remember, there were some fightings with the rebels, so on and so forth. I'm not going to go so deep in it. I'm sure most of you that are following the market as well as the energy markets in general, not only oil but natural gas as well. You know that not only the Brent crude but also the West Texas Intermediate prices dipped, but the Brent crude actually slid the most. So then on, the spread went wider between the WTI and the Brent. Due to the fact that the West Texas Intermediate and Brent crude oils are both benchmarks, there is a correlation in their prices in a historical overview. As for the period of around 2006, the Brent WTI spread was quite stable. This you can very easily try to visualize if you just backtrack on your charts. You will see the difference between the prices. You will see the spread, and you will follow it for some years to see for how long it's actually been stable. That means that the difference in the prices of the two crude oil blends was not very wide. This also indicates that the prices of the two crude oil benchmarks move very closely. Well, of course, this trend hasn't quite been true in the past few years. In fact, that is what happened for the past 6-7 years, if my memory does not lie to me right now. This should be taken very, very seriously. Moreover, it's a gradual moving back to zero levels where it used to be. So in general, the price movement of the WTI crude oil provides a basis for predicting the direction also of the Brent crude. I hope I'm making sense here. If for any chance you misunderstand something or it's not very clear, I can go over it with a few more easy words so we can cover this one more time. But the West Texas Intermediate is aiming to tighten the spread between the two blends. So by taking the direction of the WTI, you can also predict the direction of the Brent crude. The two main parts for price movements in general speaking, for oil price analysis, this is the supply and demand, obviously. As with any commodity, price is determined by the interaction between supply and demand. It's very easy. Producers and consumers rely on prices to function as accurate as they just their supply is and consumption as well. But oil is the most widely traded commodity, and of course fluctuating prices profoundly affect normal economies. To be safe against these fluctuations, many businesses take advantage of the future market to hedge themselves against the movement in the price of oil. So let's say, an example, if you are a let's say car manufacturer or some big industrial manufacturer, like you're building pneumatic machines or cranes or something like that, and you have very large consumption of petrol on a daily basis, you can hedge yourself on an electronic trading or the futures market. So if the oil is very expensive and you're constantly buying gasoline or diesel for your engines, then you can also go on the electronic trading on the platform and also buy the oil over there and, of course, profit from that exchange rate, which, of course, will totally cover your expenses, which you actually make every day to drive your car if you wish, or to reach your targets like in industrial output. Oil speculators come into play when, of course, the prices are stable and they can actually benefit from higher oil prices. Now, those speculators are also the investors, because they're mostly focusing on long-term trading. Basically, they want to buy something and hold on to it until the trend changes. They do not very much like to sell, for a very simple reason. They're not like our day trading, our day traders, which we actually used to buy and sell every day. We don't really care about direction as long as we're within it. So those people actually, they want to hold this for a long time and profit on a major scale. From the supply side, of course, is the relationship between price and quantity in oil producers, which are willing and able to produce and sell. Those are the people that are selling. So those guys, they want to have higher oil prices. However, it really depends on how much they have of a single unit. Now, if they have a lot of oil, let's say the Sahara Desert, as big as it is, imagine this with a 100, maybe thousands of feet deep underground seas of oil. Now that will take decades to pump out. So basically they don't really care about the supply on the market. They do care about the price, however, but they have so much that they can actually cope with even cheaper prices. And this is what OPEC is doing right now. They have so much oil that they're mostly actually more interested in keeping the market share in their favor instead of cutting output to boost oil prices. Therefore, we saw so cheap oil, even down to $38 very recently. From the demand side, it's very interesting, of course, the relationship between oil price and quantity of oil consumers, which are willing to buy. They want to have it cheaper, obviously. The basic law of demand is that as price of oil rises, oil consumers will respond by decreasing consumption because it's too expensive for them to afford it, or they can afford but not so much. On the other hand, as oil prices decrease and supply is abundant, oil consumers will respond by increasing consumption because it's cheap and they want to use it. The rule of supply and demand is extremely easy to understand, very simple, and this is the main factor that influences oil prices. However, if we have to take it a little bit deeper by having in mind also that we have 5 top factors that are influencing oil prices right now, except the supply and demand side, which of course is inside those 5 rules, because that's the only thing that is moving the market. Oil prices are, of course, unsustainably low right now. Many high-cost oil producers and oil-producing regions are currently operating in the red. You can see how many of the oil rigs in the North America were shut because of the cheap oil, because of the reason that they cannot really pay to their workers. So what does that mean for oil prices in today's market? It is probably already very easy for you guys to understand or guess which are the variables that are determining the trajectory of oil prices this year and the beginning of the next, until there is something much more important, something larger that it can actually offset one of those five rules, or let's say fundamentals factors, so it can actually change it and be dominant on the market. Right now, the number one is the Chinese economy. China, as we know, is the second largest consumer of oil in the world, and surprisingly, the United States is the largest importer of liquid fuels in late 2013. More importantly, for oil prices is now much more about the Chinese consumption, whether it will increase in the coming years, or most definitely in about 2017 is what we can see from the charts, from the technical standpoint. So we are expecting oil prices to remain low at least for another 6 to 8 months before it starts stabilizing somewhere above the $55 a barrel area. Of course, preferably above the $60 area. It's much more sustainable to establish a good 45-degree angle trend. So according to the Energy Information Administration, China is expected to use roughly 3 million more barrels per day in about 2020, compared to what they've been using about 10 years ago, 10 years before that, which is around 2012. Now, this is no calculation or mere speculation. This is pretty much the projection of the Energy Information Administration. This is something that you can even see on the government's website. It's no secret for anyone. Still, these are many years to come ahead of us, which we need to see some more stable oil prices to even start thinking about long-term positions, long-term profits. Although there is much uncertainty right now, China just wrapped up a disappointing fourth quarter, is what we saw, capping off its lowest annual growth in over a quarter century. It is not at all obvious that China will be able to halt its sliding growth rate, but the trajectory of Chinese economy will significantly impact oil prices in late 2016. Number two, I've categorized the American shale oil. By the end of last year, 2014, the US was producing more than 9 million barrels of oil per day, an 80% increase from 7 years before, 2007. That output went a long way to create an oil glut, which of course helped send oil prices down to $36 a barrel, having collectively, of course, cutting themselves in food. Let's say the big question is how right now affected would be the U.S. Drillers with with the prices below $60 a barrel, which is by far the best price for oil for everyone. Let's say they would pretty much like to see prices of $115 again, but to have some kind of return, at least they need to see prices above $60 a barrel. Rig counts, as we mentioned a couple of minutes ago, continue to fall. Spending is being slashed to pieces, but output has so far been stable. So much oil on the market. Whether the industry, ladies and gentlemen, can maintain output given today's prices or production beginning to fall will have to deal an enormous impact on international supplies as a result of higher oil prices, hopefully. A very important factor, however, is also the demand. This is my number 3. So the cure for, let's say, low prices, however, some might speculate that this would be the low prices, obviously, because it will find a bottom and then it will start rising. That particular saying can be applied also to both the supply and demand side of the equation. Will, however, oil selling in next year be resumed with such an aggression? This we cannot really say. So far we see some stable prices above the $40 a barrel, but we actually prefer to refrain from suggesting aggressive selling, as in some countries where oil is more regulated, let's say, low prices may not tackle down on the retail level. For example, countries like Indonesia, which will be a boon to state coffers, but will also diminish the benefits of consumers. However, in the US, gasoline prices, let's say, are now, I would speculate to say that it's about between $2 and $2.4 a gallon. However, this is more than 30% down from the mid-2014. That has led also to an upstick in gasoline consumption. OPEC and their expected move. What OPEC would do? This is my number 4. OPEC, of course, deserves a lot of credit, or of course to blame, for the remarkable downturn in oil prices for the last 1 year, while many have actually declared OPEC to be irrelevant after their decision to leave the output unchanged. The mere fact that oil prices crashed after the cartel's November meeting demonstrates just how influential they are over the price swings. So for now, OPEC, or more accurately, Saudi Arabia, has stood firm in its intentions not to cut production. Whether that remains true throughout the next year, we remains to see. And of course, not at the last place, even if it's my number 5, it still plays a very significant role over the changes of oil prices. This is the geopolitical structure, or however you want to call it. In the not too distant past, a small supply disruption would send oil prices north with $3–4 a day. In early 2014, however, violence in Libya blocked oil exports, contributing to rise in oil price. In Iraq, parts of the country and oil prices shot up on fears of supply outage. But since then, geopolitical events have had much less of an effect on the price of crude oil. Now this is very much because the market is well supplied. Let's say it's oversupplied at this stage. So whatever is happening in, if you wish, Syria, Iraq, or the Middle East in general, or even in the northern parts of Africa, in Libya, traders and investors wouldn't really care that much, for a very simple reason that we see every week build in crude stockpiles. Whether it's just 4 million, all right, with a previous week of 8 million, which is double the size down, wouldn't really matter much, or at least for the long term, because as long as we see an oversupply, a build, let's put it this way, in inventories, this will still weigh on oil prices. And this has been proven in the history. So the demonstration that we've seen in the past days or years or decades, again, the geopolitical crises are some of the most powerful short-term movers of oil prices. Whether you see a violence somewhere in the Middle East, or any kind of bomb that it's dealing some serious damage on any oil rig, this will cause the prices to skyrocket until the situation cools down, the production is resumed, then you can see the prices returning from where they came. So to sum it up, the most important factor for oil price is the equilibrium between supply and demand. Everything else that I've just stated within 5 topics, these are the most important things that every trader should know for today's market. However, in the bigger picture, in the long run, supply and demand curve is the only thing that can show you at what stage the market is right now, whether it's oversupplied and the prices are low, or it's undersupplied and the prices are high. Well, that's all about oil. Nothing difficult. It's not like, as we spoke, gold the last time. Not only supply and demand on gold weighs that much on prices, rather than other economic events such as interest rates, inflationary indicators, so on and so forth. And this, of course, is what we can see today. We saw very cheap, about $26 a slide in gold prices since yesterday. And there's still further downside to be seen. Thank you very much, guys, for joining us today for our last webinar of this month. It was a pleasure for me. And of course, next week you can start signing up for the new topics. You can find them, as usually, on our website. For any questions, statements, or if you just need a market opinion, you can always get in touch with me directly or through our support department. They can definitely send me an email or patch me the phone through right away. Thank you for being here, and see you again next time. Bye-bye.